Hey guys, today we are going to address what I think is a topic that will capture many people's attention, and that is, does it make sense to use moving averages? So we're going to go through A, whether it makes sense, and B, maybe what kind of moving averages, and then C, some tips and tricks around all of this. So let's get right into the charts, and before we really look at the chart here, let's just define what a moving average actually is. So a moving average, when it comes to a chart, it doesn't matter what the asset class is. Basically an average, a backward-looking average of price levels of whatever the underlying asset is, stock, a commodity, currency, whatever. And so what it is kind of like a smoothing mechanism, and it's at its most basic sort of hopes and dreams of the way people use it is that it gives you support and resistance levels, right? And that's really what kind of people try to use it for. So to try to answer that question, does it make sense to use moving averages? The question really is, what are you using it for, and to what extent are you relying on it? So I think if you were to use a moving average as its only single factor model, if that's the only thing you look at, and unfortunately I would say about 70 to 80% of retail investors literally do that, I think that's a very low probability way of using it. So for example, I've got a bunch of moving averages here. Let's just look at that yellow one. That's the 50-day moving average. So a lot of people say, well, it's breaking above or below the 50-day moving average, so I'm going to buy or sell based on just that. And what we call that is a single factor model, is what that's called. It's a way too simplistic way of looking at it. Now, what you want to do is you want to combine that analysis with, if you get a signal from a moving average, and see if other things line up. So let's look at, for example, the red line on this chart, which is the 200-day moving average. And you notice that if you draw some very simple trend lines, and this is, again, just a very simple analysis, but just by doing this, you're getting a higher probability trade than if you're just using a simple moving average. So you can see, if we draw and just connect these dots down here, the low from here and here and here, you can see that it is starting to line up, or did line up, with the red line here, the 200-day moving average. So when the price started coming down here, not only was the price coming down on this particular stock, this is Apple, by the way, not only did it come down to the 200-day moving average, but it also came to this support line, right? So now you're not just having a single factor model, now you're using at least two factors. Again, very simplistic, but at least you have two factors. If you want to then take this another level further, you could do something like Fibonacci retracements and see where, if from the recent low to the recent high, what kind of Fibonacci level this sets up with. Maybe that's a discussion for another point. And then you could also maybe look at and see if this lines up with any fundamental news out there, or structural news in the market, or technology stocks coming back in vogue, which was the case back here because interest rates at the time were starting to go lower again, right? So it gets more and more complex the more you focus on qualitative and quantitative data aside of just glancing at a chart, right? So again, to address the question, does it make sense to use a moving average? I say, yes, it does make sense, but don't use it as a single factor model. Don't use it as your only deciding factor to make a trade, because the probabilities are, over time, very low that you'll find any real success. So when it comes to moving averages, personally, I like to use simple moving average. There's also exponential moving average and other types of moving averages. Personally, I like to use simple. There's nothing wrong with exponentials. It's just what I like to use. For reference points and daily charts, and this is actually kind of the key point, I like to use moving averages for reference points, right? It's not an absolute tell for me to buy or sell. They are just reference points where I'm starting to do further analysis. And so for reference points, I like to use the 50-day moving average. That's the yellow line in this case. I like to use the 100-day, which is the blue line. And we talked about it before, the 200-day, which is the red line. So 3 reference points. Now again, you can make this much more complex and work on it, but if you're simply just interested to use a moving average and debating whether you should or maybe think or are already using them and deciding whether you should add some complexity to it. I hope I'm giving you some ideas of what you can do. But again, there's nothing wrong using moving average. I want to make sure I'm clear on that. I do think there's something wrong if that's your only decision that you're going to use to make a trade, because it's just too simplistic. There's way too many algorithms and smart money investors that have much more complex and more insight than just a simple moving average. It can work sometimes, but the odds over time are that it's not going to work if that's your only decision factor. But again, even just using something as simple as a line combined with a moving average, combined with maybe a news event, with a Fibonacci retracement, again, very simple stuff, can take your odds of success from at most 50-50 up to 60, 70, 80% of a trade quite quickly. Throw in there some candlestick analysis, some bullish bearish reversal stuff, basic stuff, and you start to really quickly get your odds from 50 up to 80 or so % to be successful on a trade. So I hope this is helpful. Leave us any comments if you like. If you like this kind of stuff, you want to see more of it, let us know. Thumbs up, like, and we'll see you in the next video.